Welcome to Economy Roast, where we break down the hottest economic news with a fresh perspective. On July the 30th, the US Federal Reserve dropped a big signal. Interest rates are staying put at 4.25 to 4.5% through at least September, shrugging off President Donald Trump's calls for a major cut in borrowing costs. After a two-day policy huddle, the Fed pointed to a low unemployment rate, a rock-solid labor market, and inflation that's picking up steam. This is the fifth time in a row they've held rates steady. So what's the real impact on the economy? Buckle up as we dive deep into the numbers and uncover what's truly happening. Let's get roasting.
Today, the Federal Open Market Committee decided to leave our policy interest rate unchanged. We believe that the current stance of monetary policy leaves us well positioned to respond in a timely way to potential economic developments. Despite elevated uncertainty, the economy is in a solid position. The unemployment rate remains low, and the labor market is at or near maximum employment. Inflation has been running somewhat above our 2% longer run objective. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 4.25% to 4.5% and to continue reducing the size of our balance sheet. So, as you know, today we decided to leave our policy rate where it's been, where I would characterize as modestly restrictive. Inflation is running a bit above 2%, as I mentioned, even excluding tariff effects. The labor market's solid, historically low unemployment. Financial conditions are accommodative, and the economy is not performing as though restrictive policy were holding it back inappropriately. So it seems to me and to almost the whole committee that the economy is not performing as though restrictive policy is holding it back inappropriately, and modestly restrictive policy seems appropriate.
Is that potentially adequate to make a decision to lower rates at that point?
You're right. We do have, this is an intermeeting period when we'll get two full rounds of employment and inflation data before the time of the September meeting. We have made no decisions about September. We don't do that in advance. We'll be taking that information into consideration and all the other information we get as we make our decision at the September meeting.
Seem to have an idea of what the tariff rates are going to be.
It's been a very dynamic time for these trade negotiations, and lots and lots of events in the intermeeting period, but we're still, a ways away from seeing where things settle down. We are clearly getting more and more information, and I think at this point, people's estimates, our estimates, outside estimates of the likely, effective level of tariffs is not moving around that much at this point. But at the same time, there are many uncertainties left to resolve. So yes, we are learning more and more. It doesn't feel like we're very close to the end of that process, and that's not for us to judge. But it feels like there's much more to come, as well, looking ahead. So I'll just say that we haven't made any decisions about September. We'll be monitoring all the incoming data and asking ourselves whether the federal funds rate is in the right place. I will say we had a nice visit with the president. It was an honor to host him. It's not something that happens very often at the Federal Reserve to have the president come over, let alone to visit a building. But it was a good visit. I'll just say that I think that having an independent central bank has been an institutional arrangement that has served the public well. And as long as it serves the public well, it should continue and be respected. If it didn't serve the public well, then it wouldn't be something that we should just automatically defend. But what it gives us, and other central banks, what it gives you is the ability to make these very challenging decisions that in ways that are focused on the data and the evolving outlook, the balance of risks, and all the things we talk about, and not political factors. And so governments all over the advanced economy world have chosen to put a little bit of distance between direct political control of those decisions and the decision makers. So if you were not to have that, there would be a great temptation, of course, to use interest rates to affect elections, for example. And that's something that we don't want to do. So I think that's pretty widely understood. Certainly it is in Congress. And I think it's very important. I'll just say that.
Was there talk during the meeting of cutting rates, and what was the case against that?
Two of our members felt that the time had come to cut, and that they, for the reasons that they're going to express. I won't tell you the reasons. They'll issue some kind of a thing in the next day or so. So, but that's the story, and I would say, well argued, very thoughtfully argued all around the table, good arguments, and it's a situation where, an unusual situation. The economy is in good shape, but it's an unusual situation where you have risks to both your employment mandate and your inflation mandate. That's the nature of a supply shock, and it's probably not surprising that there would be differences and different perspectives on that, as well as different views of where the neutral rate is, so that different views of how tight policy is. So we have those. I will say what you hope is that people, explain their positions very thoughtfully and clearly, and we absolutely had that today, all the way around the table. I would call it one of the better meetings I can recall from that standpoint.
The Treasury Secretary has said recently that it would be confusing for the markets if you stayed on as a governor after your term as chair ends. And I was wondering if you had any update for us on a decision on that front.
Sorry, I do not have any update for you. Thanks very much, everyone.
In the press conference afterward, Fed Chairman Jerome Powell remained cautious while keeping monetary policy options open. The agency affirmed that the current monetary policy is maintained at an appropriately restrictive level due to some rising economic risks. Following Powell's statement, the probability of an interest rate cut in the September meeting immediately dropped from 64% to 46%, according to CME FedWatch estimates. However, this week also marked the first time in over 30 years that the Fed recorded two members of its Board of Governors voting against the collective decision. They were Michelle Bowman and Christopher Waller, both previously nominated to the board by Trump. Waller is even a potential candidate to replace Powell when his term ends in May next year. The Fed's announcement stated that both Bowman and Waller wanted to lower interest rates by an additional 25 basis points, or 0.25%, at this meeting. This could spark debate about the extent of influence from Trump's public pressure on an organization designed to operate independently. Over the past few months, he has repeatedly called for the Fed to cut rates while criticizing Powell for delaying such action.
The U.S. stock market closed significantly lower than its earlier highs after a volatile trading session on Wednesday, July 30th, with stock prices rising slightly before the Fed's announcement as investors assessed stronger than expected Q2 economic growth data, though underlying details suggested the economy may be weakening. However, stocks declined after Fed Chairman Jerome Powell stated it was too early to determine whether the central bank would cut interest rates at the next meeting in September, noting that the current policy is somewhat restrictive but not stifling the economy. According to preliminary data, the S&P 500 fell 6.03 points, or 0.09%, closing at 6,364.83 points, while the Nasdaq Composite rose 37.30 points, or 0.18%, to 21,135.59 points. The Dow Jones Industrial Average dropped 160.08 points, or 0.36%, to 44,472.91 points. The market was in the green early in the session, with the S&P 500 and Dow Jones up 0.4% and 0.2% respectively at their session highs. However, red began to dominate, and only the Nasdaq held on to gains by the end of trading. According to LSEG data, After market expectations for a September rate cut rose to about 68% following the Fed's statement, those expectations fell below 50% after Powell's comments. Earlier data from the ADP employment report showed private sector job growth of 104,000 in July, surpassing forecasts of 75,000, marking the latest in a series of labor market data this week ahead of the government's jobs report on Friday. Investors are also awaiting earnings from several large-cap companies this week, with Microsoft and Meta Platforms expected to release results after the market closes, while Amazon and Apple are slated to report on Thursday.
I actually think it's kind of refreshing. The groupthink at the Fed has always bothered me, where it's a unanimous vote every meeting. I think what it's setting up is a debate for the future, and maybe around Jackson Hole, but certainly there are many, at least in my position as investors, professional investors, that think the Fed should begin cutting. They are laser focused on tariffs. That isn't even really their mandate, though they're tying it to inflation. But we think that there's a number of reasons that the Fed should be thinking about cutting. I wish the president would focus on other things, but this is how he does things. And so, yeah, I think at the margin, it's shifted the focus, and it has brought to the fore more and more people willing to say it's time to cut.
Earlier, on July 28th, U.S. President Donald Trump once again called on the Federal Reserve to cut interest rates, arguing that it would help boost the U.S. economy.
I think he has to. You had 11 cuts, In Europe, they had 11 cuts. In other places, they had 10 or 11 cuts. And we had none, but I'm not going to say anything bad. We're doing so well, even without the rate cut. With the rate cut, it would be better. It affects our housing a little bit. Look, we should be 3 points lower. Each point is $360 billion. Can you imagine that? That's big numbers. Each point, 1 point of cut, is the equivalent of $360 billion in savings. That's big stuff, Those are big numbers in the U.S. Everything's big. He should cut. A smart person would cut. He leaves very soon, so it's like one of those things, but I'll miss him greatly.
On Turnberry, if I may.
The lack of a signal from Powell regarding a September rate cut was seen by many investors and analysts as hawkish, as they had expected the Fed chairman to hint at a rate cut for September prior to the meeting. Short-term U.S. Treasury bonds were heavily sold off as traders scaled back bets on a Fed late cut in September. The decline in bond prices pushed the yield on the 2-year U.S. Treasury note up by 0.07 percentage points to 3.94%. Additionally, the U.S. dollar rose over 1% against a basket of 6 major currencies, on track to complete its best weekly gain since 2022.
Ladies and gentlemen, that's a wrap for today's episode of Economy Roast. Before we sign off, let's recap the big picture. Just ahead of the Fed's decision to hold interest rates steady, the US Department of Commerce announced that the GDP bounced back in Q2, hitting a solid 3% growth after a dip in Q1. But here's the twist. Much of that boost came from a drop of imports, while domestic demand grew at its slowest pace in 2.5 years. So what does this mean for the economy moving forward? We've dissected it all, and we hope you're leaving with a clearer view of what's really cooking in the markets. Thanks for tuning into Economy Roast. Stay curious, stay informed, and we'll see you next time for another deep dive into the numbers that shape our world.